Hello investors, welcome to Business Learnings. In this video, we'll be talking about ITC Limited. The company recently announced its quarterly results and it was not perceived positively by the market. We'll talk about the reasons. We'll also talk about whether this company is good for long term holding or not. So, do subscribe to the channel and watch the video throughout the end so that you get complete clarity. Right? Let's start. For the unaware, ITC is primarily a cigarettes company, and that's what its major pain point is. It also has diversified presence in manufacturing paper boards, FMCG, others. You must have heard of Savlon, Bingo, or Ashirwad. Right? It's also present in agribusiness, also present uh, in hotels industry. Right? So it has diversified presence across many industries. The pain point is the cigarettes business and the huge amount of revenues, and about 90-95% of its profits comes from the cigarettes business, and that's why it's not it's not getting its due value from the investment community. Let's start with the PE ratio of this company. The PE ratio of this company is just below 20. Again, as I said, the reason is PE ratio. For the unaware, price to earnings, uh, to get 1 rupee, to earn 1 rupee, how much price do you have to pay as a shareholder of this company? So that's what PE ratio means. But uh, in layman terms, look at from the perspective of how much perceived value of the companies, how much value do investment community or the analysts give to this company. That's how you should be looking at PE ratio. It's just 20, means it's kind of cheap. Investment community or analysts do not see this company as a premium company. Whereas if I see another FMCG company, if I talk about the best FMCG company in India, Hindustan Unilever, see, its PE ratio is about 70. If ITC could also have a PE ratio of 70, its price would have been about 700, more than probably 750. Why is ITC's PE ratio just 20 and Hindustan Unilever's PE ratio is 70? The reason is majority, as I said, 95% of the profits of ITC comes from the cigarettes business, and cigarette business are not given much value. See, other cigarette businesses, their PE ratios are also in the same range. In fact, ITC has the best PE ratio, probably because it has also diversified presence in other segments. And this is the pain point. What is company doing to avoid it? Company is already working a lot on building its big presence in the FMCG others, what calls FMCG others segment, and agribusiness. And it has given a target that by 2030, they will be reaching. They are targeting a revenue of about 1 lakh crore rupees by 2030, which gives about CAGR of about 15%. This year onwards, not an impossible goal, a moderately difficult goal, I'll say, and I'm pretty sure with good management quality, ITC will be able to reach that. So PE ratio is 19.8. But if I look at the revenues, let's look at the numbers, the quarterly numbers. See, FMCG cigarettes, about 7,000 crore rupees was collected by selling cigarettes in this December quarter, which means October, November, and December, 3 months. ITC sold about 6,000 crore rupees worth of cigarettes, and about 3,700 crore rupees of FMCG others. I talked about Savlon, Bingo, Ashirwad, and all those things. Good balance. The problem is not the revenues, problem is not the sales, the problem is the profits. The profit numbers from cigarettes, it's 3,700 crore rupees, and from FMCG others, it's just 243 crore rupees. That's where the problem is, which means in cigarettes, the cost to build cigarettes is much lower and they are selling it at much higher price. In other terms, their margins are way thicker in the cigarettes business, and their margins are way thinner in the FMCG others segment. Let me show you the numbers, the exact numbers. See, the margins in the cigarettes business in ITC is about 40-45%, which means that if it by approximate numbers, if it takes 1 rupee to build a cigarette, it will sell it for 2 rupees. That's what the kind of margin ITC has in the cigarettes business. But in the FMCG other segment, the margins are just less than 10%. That's the problem. The good thing is this margin is increasing. This is the EBITDA margin. Uh, EBITDA is earnings before interest, tax, depreciation, amortization. Don't go by the complexity of this number. It simply means that uh, it in very basic terms again, it simply means EBITDA simply means that the money that you earn by selling your products, subtract from that money the material and employee cost, the labor cost that incurred to manufacture that product. Right? The difference is EBITDA. EBITDA margin is simply EBITDA divided by your total revenues. This margin is consistently increasing, but it's not there yet. It's not there yet. The reason being ITC is a recent player in the FMCG space. If I look at Hindustan Unilever, see the kind of margins this company commands. About 25% is margins of Hindustan Unilever. So ITC will have to get to those levels to start, so that investment community and analysts start believing that this company has potential. All of us understand that ITC is doing a lot of hard work in building its FMCG other space, but it has to show up in the margins, and it's not showing up in the margins. It's increasing, but it is yet to reach those 25% levels. It will take years to reach there, probably. But I have some confidence that by 2030, as per management guidance, they will surely get the revenues of 1 lakh crore rupees from their FMCG others and agribusiness, and they'll also get the margins to those levels, because the reason is in the FMCG space, when you are building a product, uh, initially you will have to set up a manufacturing plant, you'll have to acquire land, set up your manufacturing plants, bring machines, set up your entire company, and then start producing. So the costs in the initial years, the fixed costs, they are a lot higher. But once you start building the products, your additional cost is just the raw material cost and the additional labor that goes in. You don't have to set up a manufacturing plant every year. In case you are expanding your capacity, you might have to probably invest in those kinds of activities, but that does not happen often, right? So this means that once you do all these setup, initially your setup cost will be higher, but down the line, few years down the line, you will not have to pay for that much money. And that's why if you keep on selling more and more, your margins will keep on improving. And that's what been happening with ITC, and that's what the reason the ITC's margins will keep on improving. And a few years down the line, it will reach at a place where re-rating, PE re-rating, will keep on happening. PE re-rating means if analyst community, investment community sees that the stock has a lot of potential, it will start re-rating it. It will say that the PE ratio of 20 is unjust. It should be trading at 40. It should be trading at 50, and that's when the stock will become rocket and no one will be able to catch it. Exactly when will it happen? My guess is about 2 3 years down the line. Until till that time, everyone has to remain patient. If you are a long term investment, if you are a long term investor, uh, you can choose to stay invested in the stock, but make sure that you have that kind of patience to stay invested. Right? Disclosure that I am invested in the stock. So I talked about the margins, I talked about the EBITDA, I talked about the FMCG business. Uh, the reason the reason the quarterly results of December was not taken positively was again because of the same margins. You see, the margins are increasing year on year, but in September quarter itself, the margin was about, and everything, all the margins that I'm talking about, it's all about FMCG others. I'm not talking about other businesses at all. This is their main business in terms of main focus area. Other businesses are way bigger than this, but this is their main focus area. This is what they want to grow. The margins in September quarter was about 9.6%, and it fell down to 9.2%. That's what the problem is. That's what happened, and that's why the stock was beaten down in the last trading session on Friday. The good thing is, the stock has announced an interim dividend of about 5 rupees. So, um, last year we got about, what, about 10.15 rupees, and by the end of this financial year they will also announce some dividend. So, in terms of dividend, about 5% dividend yield, you will surely be getting every financial year, and that's probably better than the, almost at par with the FD returns that we get, and the capital appreciation will be additional few years down the line when the stock is re-rated. So this is my analysis of the stock. There are other parameters also in terms of ESG, which I'll not talk about because I think ITC has already solved for it. That's not a problem. Um, it's probably one of the best companies in the governance area, in the social area, in the, yes, I was talking about, the company has already solved for the ESG thing. The company is rated good in social and governance, just that it's not so good in the environmental because of the cigarettes business. Cannot do anything about it. Another reason was the oversupply of shares. You see, the promoter holding is almost zero, although there is a promoter, an indirect promoter, but the promoter holding being zero, you see, promoter holding is zero here. Most of it is held by public DIS and FIS, and that's why there is an oversupply of shares. And when there is an oversupply, it's very easy. The stock prices do not move much in either direction, right? So that's what my analysis of the stock is. I'm very positive of the stock in the long term, but only the people who have a lot of patience should be investing in this kind of company. Uh, it's not your cup of tea if you cannot sustain the same price for at least the next 2, 3, 4 years. And yes, this is a long term hold, uh, and that's what my understanding is. That's what my analysis is. I'm not a SEBI registered investment advisor, so please do your own research, consult your financial advisor before investing in the stock. Happy investing. Thanks a lot for watching. See you in the next video. Bye.